Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, June 4, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And the market's pretty much doing exactly what we anticipated it was going to do based on the last several Common Sense Market Analysis videos. So we are, across the markets, for the most part, breaking out of this consolidation pattern. The Nasdaq's already at new highs. The IWM is at new highs. We'll talk about those when we get there. But as you can see, the S&P 500, the SPY, is beginning to break out. We're approaching the first level of resistance I thought we would see, which is 275.45. Now, the fact that we consolidated sideways beneath that level for quite a period of time and even dipped down on this one-day fake out all the way down here on the 29th of May. So that really resets the market. So I would not be surprised at all if we just kind of waltz through 275.45, especially after coming up just short today, about 25 cents short. We can certainly waltz through that level. 278, 280, 282.79 is our next potential levels of resistance on the upside should this market continue higher. But let's talk about both sides of the equation. Let's talk about some divergences we see and what we can read into them. We're going to look under the hood. We're going to put all the puzzle pieces we can on the table, and I'm going to give you what I think is going on in this market and what I think the market is likely to do over the next several days and slightly beyond. But first, let me thank everybody for participating, posting comments under the videos. Please continue to do so. It's helpful to everybody. Comments about the market, feelings about the market, long side, short side, technical analysis, economic analysis, whatever it may be. Let's continue the conversation by posting comments on the videos. Thank you very much. In addition, please continue to like the videos and share them with people that you think can benefit from this information. It's helpful to me. It's helpful to them. We're all just paying it forward a little bit, so I thank you for that as well. So let's get back to the markets. Let's start with the bigger picture. In fact, let's go over to a weekly chart and start with a bigger picture there. So as you can see, and keep in mind, it's only Monday, so this weekly number right now where we are is not significant until the week closes on Friday, but this is the level that's going to be important. This high of 274.40. We're above it now, but if we close above that by Friday, that's going to be extremely bullish for the SPY. Now, also, keep in mind, just from a visual perspective, if you believe at all in market symmetry and you believe in the patterns that we watch play out over and over and over again, you can see this is essentially a bull flag pattern, a bullish pullback pattern. A bullish pattern, any way you want to look at it, generally will result in a continuation move. We're beginning to see that move. Will we see the full market symmetry? Way too early to tell. No way we can know that right here, right now. However, what we should note is the volume remains very light across the markets. We've said this time and time again. Path of least resistance is to the upside in light volume. So we're seeing the markets levitate. There's buoyancy. Good news is good news. Bad news, nobody cares. We're in that state again. The sentiment is bullish. The markets want to push higher. You have to let that happen until and unless two things happen. The character of the market changes and or we trade below and close below a certain level. Right now, there's a level that's important to me is 270.42. That's a ways away from where we are right now. That's a pretty decent drop from where we are right now. There's another level that's more important to me in the short run, which would represent, in my mind, a failed breakout. So if this market were to come back down, if that were to happen, and we closed below 273.25, that would be a warning sign for the daily chart of the SPY. A close below 273.25. Two closes below that level, a second warning sign. So we'll deal with that as a first level of defense, potentially offense, if we should get there. Right now, we're headed in the other direction. We're on a breakout, but we're going to watch that level if this market should turn around and head in the other direction. Anything below that level, we'll worry about it when and if we do get there. At this point, the only thing we're looking for in order to establish a short position, for that matter, is either close below 273.25, and then we would need confirmation below that. I'm really looking for a secondary close below that level. That would be confirmation that we're potentially in a failed breakout environment. The other thing we're looking for is a potential reversal day, high volume reversal day, doji candle, some signal of a trend change, and there's a number of them. I would be looking for something from at least an intraday or daily chart perspective to tell me that the market is likely topping out and likely changing trend, ready to head in the other direction. Until and unless I have either of those things, we're going to anticipate that the market will trade higher until it tells us that it's not. Right now, until the market tells me otherwise, I'm not interested in the short side. We're in the midst of a breakout. There could be a lot of upside. We could be, and keep this in mind, we could be in the early stages of another melt-up scenario that could take the market higher than most people think it can. Will we get to new highs? I don't know. It's not really that important just yet. I don't necessarily have new highs on the calendar in 2018. Not to say it can't happen, but the market can certainly go a lot higher than people anticipate it generally can. And same thing on the flip side. It generally goes a lot lower than people expect that it can go. Here's a chart of the IWM. This is my favorite market leading indicator, bar none. You can see here that the IWM is on an absolute breakout to new highs. Now, the money that flows into the small cap index, the Russell 2000, is risk assets. That's what that money is destined for. It's destined for growth. It's not destined for safety. We're going to see the same thing when we look over at the tech sector, namely the triple Qs, the NASDAQ Composite, the NASDAQ 100, any of the tech sectors that we look at, we're going to see the market breaking out to new highs. Now, there's a couple of things going on. We can look at it a number of different ways, and we have to look at it as many ways as the data will show us. But in one way, we're on a breakout. So obviously that's positive. We're not going to short new highs. That's a fool's game. We never know where the high is actually going to come in. We always wait for a sign or signal of a trend change in order to do that. Right now, we're letting the market break out. If you're long the market, you ride her as long as you can. If not, then you just wait for the market to tell you or provide you additional information, whether it's a trend change or we can identify a pattern that's going to tell us even higher prices are coming. So, we have breakouts to new highs in tech and small cap. We also can look at it as sector rotation. We did have some weak sectors today, namely the transports. We'll get there in a moment. The transports were weak. The banks weren't particularly strong today. So it may be just some sector rotation, but look where the money is rotating. The money is rotating into assets destined for risk assets, or risk capital, I should say. So that capital that's flowing into the NASDAQ or the technology sector, into the small cap sector, that capital is expecting higher highs. They are expecting growth to continue. We're not going to get this super divergence where you get the tech sector rising, the IWM or the small caps rising, and you get the Dow and the S&P going in the other direction. That's unlikely to happen. What's likely happening here is we're starting to see a breakout in the small caps. We'll take a look at the Qs in a moment, and it's going to likely pull up with it the S&P 500, and the IWM will end up pulling up the Qs. Everything will be a rising tide, lift all boats scenario. Just be careful. This market can get sucked up a lot higher than people think that it can. And if it doesn't, and we experience a trend change signal tomorrow, 2 days from now, whatever the case is, then we'll deal with it at the time. Right now, you ride the trend. You don't fight the market on extremely light volume in a float mode leading into the summer months when the volume is going to continue to dry up and get less and less each and every day that goes on throughout the summer months. If we see a pickup in volume and that's on the downside, then something else is developing. So we just have to be careful and watch out for when the market does give us a specific signal. Right now, the trend is higher. Looking at the VIX, we can see the VIX coming down. We filled that gap we talked about the other day. The VIX is coming down potentially into our zone. I'd be interested again at the VIX around 11.5. That would be interesting to me. Not so much in the 12 camp since we were already around there. The low here was 12.29. So I would like to see it really come down into that 11.50 that I was originally looking for. That would be an interesting price in the VIX. Other than that, it looks like the VIX wants to go lower. That traditionally will mean higher prices for stocks. So the VIX came off 5% today. You can see where we really had just that wonder spike up, and now we've had several days of collapse all the way back down below all the moving averages. The VIX looks weak and getting weaker. So the transports were weak today and showed no relative strength, underperformance in the transports. Is it just sector rotation? Right now, that's the way we're going to have to look at it. Why is that? Because really, and again, the same trend line we draw every night, is we're really just trading at the top end of the channel. Here's the bottom of the channel. Here's the top of the channel. You want to move the top of the channel up to here where the pivot highs are? That's fine. We're still just trading at the top end of the channel, no matter where you draw the top end of the channel. So we're above all the moving averages. We're going sideways to higher, just going back and forth. Technically speaking, there's really nothing wrong with the Dow Jones Transportation average. The daily chart still is in a bullish position. Higher prices can be coming. I think we are seeing some sector rotation, but not in a big way. Some of the transports were down today, not others. Some of the rail stocks were down, trucking companies were down, but other transports were up. So I think it's just trading in and around the top end of the range. I'm not going to really read anything more into the underperformance of the transports just yet. If we get some persistence on this matter on the downside, that'll be something different. So right now, it's a puzzle piece. We'll put it on the table. But right now, it's just a one-day thing. We'll see what tomorrow brings in terms of the transports. Looking over at the Qs, you can see what we're doing in the Qs. We just closed today at a fresh closing high in the triple Qs. Previous closing high, 174.08 down here back on the 12th of March. And today, 174.30. So we'll see, is it a fake out? Are we just going to close at a new high one time and come back down? Or is this a legitimate breakout? Well, I'll tell you that the Qs look strong. We're above all the moving averages. We consolidated for a decent period of time, so this breakout should come as no surprise. So it's likely, even if we don't get through the highs on the first run, the high on the triple Qs will be 175.21, so about $1 higher than we are now. We could see that even tomorrow. We should see at minimum of a test of that high. Whether or not we get through it on the first go-around, we'll see what happens, but we should at least get a minimum of a test of the highs, which is about $1 higher in the Qs. Going over to the financials for a moment, you can see here in the XBD, was up a little bit today, but more fractionally up than anything else. We can't really gain any new information from the activity on the XBD chart today. It's basically making a bearish pattern, so we've come down from the last pivot high, now making a bearish pattern sandwiched in between the 20 and the 50 period moving average. If we can get above and begin closing above on the daily chart, the 20 period moving average, right now coming in at 293.20, then that'll be slightly bullish, or certainly more bullish for the XBD. But if we continue sideways like this, or even get below the 50 and begin challenging the 100 again, that's going to be bearish and likely promote lower prices in the XBD. we're going to need participation from the financials if this market's going to be in a breakout mode. It's unlikely that all the indexes break out to new highs. The S&P 500, the Dow, the NASDAQ Composite, the IWM. It's unlikely that we break out. And by the way, they're not all going to break out to new highs, all-time highs, just recent highs. It's unlikely that we're going to break out, continue to break out, without participation from the financials. It's a big component of the S&P, and it's unlikely that the financials wither away while everything else continues to power forward. So think it was short-term sector rotation. We'll see. The financials are struggling a little bit. Above the 20-period moving average XBD will be positive. But looking at the XLF, again, this is significantly weaker than we're looking at in some of the other indexes. Think about the look of the XLF against the IWM making new highs, the NASDAQ or the triple Qs approaching old highs, made a new closing high. So you picture that against the XLF where we have a high, a lower high, lower highs. We haven't even got back to the third lower high or the secondary lower high. So this is significantly weaker, and the financial sector is certainly telling us something different than the other indexes are telling us. Look at the weekly chart. This is a bearish pattern. This is telling us that price wants to go lower in the financials. Is the financials, or are the financials, a canary in the coal mine? Here are the transports. Okay, the transports, I can still make a very strong argument that this is still in a bearish pattern, although on the weekly chart we're above all the moving averages. So I have some conflicting information. I can make a case either way, and when I can make a decent case either way, there's nothing to do. That's the problem. So can't get any real clear picture from the weekly chart of the transports. We can certainly go in both directions, higher or lower, based on this chart. But when you go over, and that's in the transports, but when you go up and you look at the XLF on the weekly chart, that's telling us a different picture. The daily chart, again, below 3 out of the 4 moving averages I like to use. That's telling us a different picture than a lot or the majority of the other markets. What about the SOX? The SOX are bullish. The daily chart, we're above all the moving averages. We're making a run for the old highs back from March. Okay, but we're not seeing the same thing in the financial sector. When you look at the weekly chart of the SOX, very bullish. We're above all the moving averages. It looks like we're just going to challenge the old highs, and if we do, what's the likelihood we stall there or just bust right through? This is bullish. I wouldn't be shorting this kind of tape right now. I wouldn't be shorting this type of chart pattern right now. No way, no how. What about some of our market-leading stocks that we haven't talked about in a few days? So here's a shot of Amazon. Amazon at new highs, continuing to do well. Facebook challenging old highs, continuing to do well, coming up to a double top. Very strong. After even some of the problems and the issues they've had in the media didn't seem to affect the stock. Netflix at new highs. Nothing wrong with this stock. Very, very strong. Google, not at new highs, potentially could put in another lower high, but look at this bullish pattern that really just played out already. Can't say that we won't go higher, but in terms of this pattern, and does this look familiar? Isn't this what we've been drawing in the NASDAQ and the SPY chart? And look what happened. There's your market symmetry. Here to here, and you can see the symmetry. We may continue higher, that's fine, but this is the same thing that we've just drawn in the SPY chart probably a dozen times already. That's the way these patterns play out, typically to the upside. So Google daily chart, strong. How about Baidu? Look at this, continuing to repair some of the damage done, but Baidu's still not necessarily in terrible shape. What happens when you go over to a weekly chart? Is there anything wrong with Baidu? We're above all the moving averages in an uptrend. Pretty much everything is sloping upward. There's nothing wrong with Baidu. We can certainly do some back testing here and there. Nothing wrong with Baidu. A big stock, big widely held stock. Alibaba, another one, making new highs. What's wrong with this market? There's nothing wrong with this market. We can't be biased to the downside when you see charts that look like this from all the leading stocks, all the leading names that we hear about each and every day. These are the ones, these are the hedge fund favorites. These are the mutual fund favorites. Don't fight those guys. Don't fight the big money guys. Look at this breakout. What was this? Sideways consolidation pattern, breaking out to the upside. Look familiar? We've talked about this over and over and over again. Here's the same chart in Alibaba, already breaking out, part of the triple Qs. All right, downshifting here a little bit. We'll take a look at the gold market, and gold's struggling. Gold is below the important level of 1,297 spot 50. That represents this particular low of this green candle, and if we close below that level on the daily chart, that's going to mean likely lower prices coming for gold. This pattern would likely play out to the upside until and unless we closed below 1297.50. If that happens, that's going to be downside pressure for gold. You don't want to be long gold in the face of that potential close. And crude oil coming down. Let's talk a minute about crude oil. Is the upside over? I'm not ready to declare the upside is over just yet. Last video, we talked about the fact that when you look at the long-term chart, the weekly chart, we can make a case that we've had some pretty severe pullbacks in crude oil and still continued the upside. So I'm not ready to just throw in the towel yet. I've got three important levels on the chart for crude. 64.50, we basically came there today, just a bit short. That's an important support level. So 64.50 may hold, and if it does and we start back upward, that may be a sign that we're near a short-term bottom and we can begin another trek to the upside. If 64.50 doesn't hold, we're going to look down towards 63. That should represent another very, very strong buying opportunity in crude oil. I will be, based on how and if we get there, when we get there, I would be interested to buy at around 63 to 63 and a quarter, in that neighborhood, 63.30. In that zone, I may be interested to buy the CL contract crude oil. And 62, if we begin getting down to and closing below $62 a barrel, I think the party's over, the end of the road, and much, much lower prices are coming. That would be it for the upside if we were to go and break below and begin trading below, closing below $62 a barrel. So those are my important numbers, my lines in the sand in crude. I'm really looking at 63 and change. I would like to be a buyer down in that zone. And with that, folks, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.